Hi, everyone, and welcome back. I hope you all had a very lovely break over the festive season and the new year. Look, we'll just wait for a couple of people to join, but I'll just introduce our managing principal to you, Ian George, who's going to present to us all on planning for the year ahead. So Ian's going to look at ways of planning, increasing and protecting wealth. But whilst we wait for those last few people to join in, maybe just take a minute to think about what your New Year's resolution was. I'll hand you over to Ian and he'll kick us off very shortly. Thanks, Ian.
Thanks, Yvonne. Thank you for joining this Women in Focus webinar. It is part of a series that we've created for women who want to be part of their and their families' financial decision-making process. Today, I'm going to revisit one of the sessions that we held last year, Planning for Your Financial Future, and also talk about New Year resolutions. I'll then finish with an overview of what to look for in 2021 to plan for your financial success. So I guess in terms of our desired outcomes, it's really about recapping those key issues of our previous session. More about the New Year resolutions and how to make those successful, plus in regards to planning for your financial success. The presentation would be for 20 minutes, but with enough time for questions and answers. And if you can put the questions and answers in the box at the bottom of your window, we can follow those through. I guess if we can first start with identifying the gaps. For women who do want to take a more active role in managing their finances, there are generally some common gaps that need to be addressed, whether that's financial literacy, wage inequality, investment risk and superannuation, or time. If we start with financial literacy, according to the Hilda surveys that the Melbourne University run, there are some dividing between men and women in regards to literacy. And it is found that on average, that women do have a slightly lower measure of literacy. Wage inequality. Unfortunately, women do suffer statistically to wage inequality just due to breaks and instances of career breaks, caring for children, caring for elderly parents. All of this has in terms of an impact. If we do follow that through to superannuation, the various studies done on retirement clearly indicate that there's a gap between the savings that men and women are able to accumulate on average over their lifetime. And a significant gap of that at, from the studies, $113,000 on average. Time. Again, according to research, women are living in a time-starved reality. I guess because in terms of women do put up their hand for responsibility for the entire family unit, and generally, in terms of it's both the paid environment plus the unpaid environment. I guess in terms of, if we look at bridging the gap, so here we've got both an educational issue and an action issue. Conceptually, I guess it is quite simple. If we do want to, for example, if we do want to lose weight, we do need to eat less and move more. But despite this simple idea, most of us struggle to lose weight. And why is that? It's not a knowledge issue. It's the implementation issue that's the hard part. But it all does start with having a plan and then implementation of that plan. The success of having a plan also comes down to goal setting. To have a successful plan, we need to have clearly defined goals. And too often, people operate with the all-encompassing goal of just amassing wealth, rather than the specifics of what they'd actually like to accomplish, trying to break it down into smaller pieces or smaller tasks. If we start, we first need to articulate our goals and set a timeline. Outline what financial goals you would like to achieve, big, small, and I guess the in-between, and then group those goals into time buckets: the short term, the medium term, and the longer term. Next, we'll need to quantify what those goals are. How much will it cost? And there are some examples. I guess next, we do need to look at reality and assessing reality. If we know what we want and what it will cost, we can turn our attention towards the current progress towards this goal and what steps we might need to make these goals a reality. Think about what we can do. Is there a regular saving that can be used to contribute towards, the acquisition of a property or an investment plan? Are there risk protection mechanisms that we can put in place in cases of health changes to cover future costs? Also assessing returns needed to achieve those goals versus our risk appetite. Often our goals will conflict with each other, and we will need to prioritize our goals. And it's not just our goals. We need to think about the goals of our family and how those interplay with each other. For example, do we look at high interest debt paydowns compared to, building an emergency cash reserve? Our retirement savings, we need to start now. We can't get the time back. For our education savings, can we rely on any external sources to fund, like the government's help scheme? Are there other short to medium term goals that we need to plan for? Maybe it's a car replacement. Typically, when we have a goal, we like to, I guess we're advised to try to set SMART goals. Goals that are specific, measurable, achievable, realistic, and time-bound. The SMART goals help you articulate the goal, plus set a timeline to quantify what that goal is, to assess reality, and to prioritize. But using the tool of the SMART goal is a good way to do that. We've found that using a tool, such as the tool that Morningstar, one of our partners, has published, which is effectively a mining your goals questionnaire or template, can help us really set out what and help us establish what those goals should be, and help us to complete this process. Because it's not that easy in terms of to set out and to what our SMART goals should be to make them achievable and realistic. So as I mentioned, this template is a good way of finding out and assisting in that planning process. And we are happy to share this with you. But it is something that we do use in our own business and we have found successful. particularly with in terms of New Year, it is common for us to make New Year's resolutions, whether that's to exercise more, to take control of your finances, build that investment portfolio or buy that investment property, give that business idea a go, or to learn a new language. These are all common New Year's resolutions. Unfortunately, many of these New Year's resolutions ultimately fail. And what are our excuses? A lack of time, I guess a feeling that we are failing, a change of priorities. We didn't properly think out what that resolution was or what it meant. We didn't have the right support. Or we fall into that trap of, I'll do it later, or I'll start later. Ultimately, these are all symptoms of failing to plan properly. So it does come back to planning, and more planning. But what if the SMART goals are not really working for you? And as we know, we're all different, and different techniques and different tools work for different people. There is some emerging research that was done by Christian Swan, who's an associate professor of psychology at Southern Cross University, that suggested that specific goals can put us off in some cases. So for instance, we might have set ourselves a task of being more active and really aiming to walk 10,000 steps per day. These days, our phones remind us almost each day what we've done. But, but I guess some of these goals can be seen as all or nothing. So what would happen if, we did 9,000 steps one day? Do we might feel as though we've failed? But when reality, in terms of we might have had an extremely busy day, there might have been, in terms of a lot happening, and those 9,000 steps on that day might have been a fantastic achievement. So we can see that sometimes these all or nothing goals can be a disincentive. So I guess if you're not sure about what the right goals are for you, or you're starting to feel that you're not making progress towards the goal, and the temptation is to give up or to put it off, then perhaps an open goal is something for you as an alternative. So what is an open goal? It is really just an alternative planning tool. It's non-specific, exploratory. I guess it's often phrased as aiming, see how well I can do. So if we take our activity example, to set an open goal, we would think about what we want to achieve, being more active, identifying what we want to measure, I guess our daily average step count, and then phrase the goal in an open-ended way. I want to see how high I can get my average daily step count. If we apply this to a financial goal, an open goal might be reducing my home loan. So if we identify what we want to measure, it's really that average monthly additional voluntary loan repayment, that extra loan repayment that will make us make the difference. And then phrase your goal in an open-ended way. I want to see how high I can get my average monthly additional voluntary loan repayment to be. I guess if we look at the bigger picture and looking at planning forward in terms of and looking at financial success and what the keys are for achieving success, it does all start with developing a plan. Part of that plan is really to understand your cash flow and really what it is spent on, the different categories of your spending and your habits. And again, we can do this either individually, if that's appropriate, or more commonly as part of the family unit. Once we've got an understanding of our cash flow and where it is being spent, it's really then sitting down with, in terms of the family, and discussing and understanding what your family's goals are. Each of us will have our different priorities, but then it's about trying to set priorities. I guess much simpler if you're doing this plan on for just yourself, but ordinarily, again, we've got to consider the family unit. So there is competing priorities. It will come back to the family budget. And that's obviously a very critical part of understanding your cash flow and knowing what it is spent on. I guess it's the importance of also setting yourself to know that you will need some reserves and factoring that into your budget. It's also about knowing our weaknesses, knowing where that discretionary money is likely to end up and having an awareness of that, and also having the discussion with the family units about that and what actions we might take. The monitoring process is also critical. While we might have a plan, we've got to know if that plan is working, if it's being implemented, if it's being followed. And we can't do that if we don't monitor its progress, having those check-ins. Holding yourself and family members accountable. Again, we're not trying to be draconian. We're just trying to come back to that initial family discussion. We've had our discussions, we've had our understandings, we've set our priorities. Let's follow through on what's important or what you've identified as important. Being accountable to yourself and to the family. I guess building your wealth. We can't stress importantly enough the importance of regular, weekly, monthly contributions. It is really the only way to really build wealth. History tells us that if we hold off and seek to make and look for that larger amount to help us get forward, something always happens to get in the road of it. We need to have those regular, weekly, monthly contributions. The importance of paying yourself first. If we have identified that, that it's important to have and to make a regular contribution, we've got to make sure that that is a priority and that is done first. Let's get it up there. It's a bit like if we know we have to make a mortgage repayment each month, that's a priority. We also make the priority of putting money into our savings plan, or putting additional payments against the loan, or paying off that credit card, or putting money towards a savings plan. It's also critical that we reduce our non-deductible debt. We need, in terms of our debt, to work for us from a tax point of view. So whether it's your home loan, whether it's a credit card, we need to make sure that that debt is repaid first and is repaid as quickly as we can do. And there are some strategies that we can use to help turn and I guess more quickly reduce that non-deductible debt. The most common of that is in regards to having additional weekly, monthly contributions towards your home loan, where we can have the power of, in terms of compound interest, working with us and reducing your loan at a much faster rate than we would have otherwise have. It is also about investing tax effectively. If we do have long-term savings goal, then superannuation is a perfect vehicle for that. Simply because of the lower and concessional tax rates that we're able to use in that superannuation environment, either at a 15% rate for general investment income, or at a 0 rate if we're able to turn that superannuation fund into a retirement or a pension stream. Within that, we know that there are limits on contributions and what we're able to contribute to superannuation. But again, I guess, and with government policy changing over the years, an important aspect for women where career breaks, I guess, have got in the road of making larger contributions or maximum contributions, we do have the ability to make catch-up contributions at the moment. So we've got what's called the bring forward rule, which might allow contributions that weren't able to be made in a previous year, able to be made in a current year over and above the normal $25,000 contribution limit each year. There's also, in terms of business structures, considerations in regards to, I guess, investing, about whose name taxable income ends up being taxed at, or investment income gets taxed at. And in terms of the timing of when that income might be taxed, by looking at some deferral strategies that are available for those people in businesses that do have either companies or trusts. It's also important that we protect our wealth and really have appropriate ownership of assets and investments. There is an idea of a risk taker and an asset holder. So in terms of a risk taker, is not going to the nth degree, but I guess it's considering someone that is in business, someone that is a company director, someone that is an office holder with a, in terms of a not-for-profit association. All of these are examples of someone that has taken on some additional risk. So I guess where possible, we do try to protect ownership of the assets that you've worked so hard to build and the investment portfolios that you've worked so hard to build by holding those in the names of the asset holder or someone that has not taken on those additional risks. While this is not always possible, it is also possible to look at some other asset protection strategies that we can talk about a little bit later. It is also about taking advantage of the capital gains tax and land tax concessions for our main residents in terms of property. Clearly, these provide us some big advantages and should be used wherever possible. Where it's not possible for our assets to be held appropriately in our individual names, we can look to use trusts to hold and protect assets. So a trust is simply a vehicle that where assets are not held in our own names, but are held on behalf of us and can be controlled by us. But clearly they are very important in terms of to use and to hold and protect assets that we've worked so hard to build, plus also in terms of to structure our income flows and the tax that goes around that. A superannuation fund is a type of trust, and it's a very important vehicle for us to hold and protect our wealth. Our superannuation does have layers of protection that are provided under the legislation that make it more protections than there are if we held those in our own name. There are also the nominations or the binding death nominations that direct where our superannuation will go on our passing, and they're also very critical in terms of protecting your wealth to make sure it ends up at with the people that you would like it to end up with. In a previous session, we also covered insurance and the role that it can play in protecting your wealth, whether that's life, total and permanent disability, or income protection. They're all aspects of protecting the wealth that you've worked so hard for. Finally, we've also got the importance of having a will, making sure that it's up to date and in terms of that it does express your wishes. Part of the will might involve a testamentary trust, where we want to put some additional layers of protection around the assets. Just as important is our powers of attorney, whether that's financial or medical, or our guardianship for our children. All of those are quite critical. We do have to show our disclaimer in regards to this presentation that it is general advice. So I guess what's next? If you would like a copy of the Mining for Goals template to help with really your planning and setting your goals, we can definitely share that with you. If you'd like to reach out to us with regards to any questions or any aspect of this question, please do so. We've got an email address there or our general emails. But I'd really like to challenge you to establish a plan and then to have that implemented. We do have some time for questions and answers. And if I can open the floor to Siobhan to guide that. Thank you.
Great. Thanks so much, Ian. I personally think that was a really good overview of some important keynotes when it comes to planning for wealth, protecting wealth, and ways of increasing wealth generally by changing our outlook. And now, look, just before we jump into, we've got a few questions here, but I just really wanted to take this opportunity to thank everybody who has attended over the last few sessions for the Women in Focus series, and just to acknowledge that we've actually donated $1,000 to the Red Cross Society on behalf of one of our regular attendees. So going forward, we'll continue to make this regular donation to qualifying charities. So if you want to be a part of that, or if somebody you know who's joined the sessions wants to be a part of that, please reach out to us. Ian, a couple of questions that have come through, and I'm just going to sift through them. We can get back to people after this. But could you just expand on paying yourself first concept?
Sure. It really just is trying to match our priorities. So if we have identified that, this is important, that we say put $500 a month into a savings or investment plan, we know that we've only got a limited cash flow each month. So we just need to prioritize and make sure that that happens. And a good way of doing that is really to make sure that we pay that first. So that's simply paying yourself first. And I guess it's an acknowledgement that budgeting is not easy. And, most of us are not that good at budgeting, but it just removes that opportunity to spend and for it not to happen.
Yeah, sure. No, that makes sense. And then another question that's come through says, you've mentioned paying down non-deductible debt as soon as possible. Are there any ways to do this faster?
Yeah, well, yes, there always is. And it really does come back to trying to make some regular additional contributions wherever possible. And the more frequent you can make these additional payments, the faster your debt will reduce, really. Again, we need to start with the highest, the debt with the highest interest rate. And typically that is credit card debt. But unfortunately now we're also seeing some of the, I guess, the afterpay debts, or the buy now, pay later, supposedly interest-free payment plans. And the problem here is that as soon as we don't meet any of their strict payment terms by, say, paying 1 day late or something in that regard, we find that there's suddenly a 22 to 25% interest rate applied to our loan. So it's about making sure that if we do have those, that we can strictly comply with the terms, but to try to, to make other contributions. There, an alternative might also be if we do have some small investments that, we could possibly sell down and use the proceeds of those investments to effectively pay down some non-deductible debt. The idea would be then, if we have a redraw facility available on a loan, which is quite common these days and quite readily available, provided that there's security being able to be provided, then we can withdraw effectively those same funds and make the investment again. But this time, the debt on the redraw will be for a tax deductible purpose, and we've turned a non-deductible debt into a tax deductible debt. This will obviously help with our tax liability and reduce our overall tax liability, which might mean that there's surplus funds to then more quickly pay down other non-deductible debt. I guess in terms of in any strategy, we've got to consider what costs there might be for selling investments or selling assets. And in our case, we'd have to consider any capital gains tax that might be payable that you'd have to consider before implementing such a strategy.
Wonderful, Ian. Thanks for that. If I'm like anybody else, I wish I had have had that advice about credit card debt maybe 10 years ago, but thanks very much for that. Now, look, we do have a few more questions, but just being weary of time, what we might do is close off here, and we'll get back to everybody individually with the questions that you did have. But I really wanted to just introduce you to the next session that we're going to be having in February, which will be hosted by one of our senior advisors, Scott, who's part of our financial planning team. And he's going to take us one step further by looking at the state of the investment market and the market indicators. And that'll be really around the influences of key decisions and risk appetites. So in the next couple of weeks, we'll send through an email invitation, but please make sure you sign up for the next session and make the call for actions and plan your journey more holistic. Once again, we just want to thank you for joining us, and we wish you a very prosperous 2021, and we're looking forward to seeing you next time. Thanks very much.
Thank you.